Sentinel stock is down about 35% today, and in my opinion, it's a great buying opportunity. In this video, I'm going to discuss why the stock is down significantly today. I'm going to go over some financials, and finally, I'll do the valuation of this stock. Before we move on to the details, I want to clarify that this is not financial advice. I'm not qualified to give financial advice. I'm just recording my thoughts about Sentinel stock. The main reason why the stock is down today is because of their forward guidance. The street was expecting $637 million of revenue this year, but Sentinel is only guiding for $600 million of revenue. That's $37 million less revenue than what is expected by the street, and that has caused the stock to sell off. This $600 million of guided revenue represents about 42% year-on-year growth, because last year they made about $422 million of revenue. $422 million last year to $600 million this year represents about 42% year-on-year growth. Let's quickly look at their financials. In the most recent quarter, they grew their revenue by about 70% to make about $133 million of revenue. GAAP gross margin was about 68%, which is significantly better than the 65% gross margin last year. So this is definitely good news. And with respect to cash equivalents, and short-term investments, they have about $1.1 billion. This company's market cap at $13 stock price today is about $3.5 billion. So the cash of $1.1 billion is almost 30% of their total market cap. That's a very good position to be in. Now let's move on to the valuation part. Please note that I have done multiple videos about Sentinel in the past, and I've discussed their business model, growth prospects, and also acquisitions. So if you want more details on those topics, please refer to the previous videos. In this video, I'm just going to keep it short and just focus on the valuation because they just reported their earnings. For the valuation, I give two different cases, one with reasonable assumptions and one with great execution. Let's talk about the case with reasonable assumptions. In 2023, I'm assuming that they can get to the $600 million of revenue like they have guided. I'm assuming 35% growth rate year on year. You can say that in the most recent year, they are guiding for 42% year on year growth. And when they get bigger and bigger, it's hard for them to grow. So why not 30%? Why not 25%? The answer to that is simple. This company is still small. They barely make about $400 million of revenue, right? So it's easier to grow when you are actually small. So 35% growth year on year is reasonable for the company of this size. So with that, they will make about $2 billion of revenue in 2027. As I mentioned before, this company is achieving 68% gross margins. And for a company that makes 68% gross margins, 23% net profit margins are typical. So with a 23% net profit margin, they can make about $0.4 billion of net income in 2027. For a company that is growing in the 35% rate and has a net profit margin of 23%, I can assign a multiple of 27. So I'm using the same multiple here. I can give it a premium and apply a 30 multiple, but I want to keep it conservative. So 27.5 multiple gets us to a $12 billion of market cap in 2027. With respect to number of outstanding shares, this company currently has about 288 million outstanding shares. They do give stock-based compensation and dilute the shareholders. I'm assuming 5% dilution. Note that in the most recent year, they diluted the shareholders by about 6%. But as the company grows bigger and bigger, the stock-based compensation will go down. And therefore, I'm assuming 5% dilution, which I think is reasonable. With that, they will have about 368 million outstanding shares in 2027. When I divide the $12 billion of market cap with 368 million outstanding shares, I get a stock price of $34 in 2027. Currently it's at $13, right? So that's about 158% gain in 5 years with reasonable assumptions. We now move on to the great execution case. I'm assuming 45% growth rate for this company and 25% net profit margins and a 30 multiple. With that, the stock price would be about $54 in 2027. Currently, they're at $13, right? That represents about 316% gain in 5 years, which is really attractive. In conclusion, I'm estimating 158% gain in 5 years in the reasonable assumptions case and 316% gain in the next 5 years in the case with great execution. So I think this is a great entry point. I did add some shares of Sentinel One today at about $13 and $14 stock price, and my current average stock price is at about $14. I will continue to add to my position as long as the stock stays below $15. Let me know your thoughts in the comments. Thank you so much for watching.